Welcome to your weekly dose of market drama. Before we get to the main event, which is the Federal Reserve, let's start with earnings, which is the midst of earnings season. 52% of companies in the S&P 500 have reported results for Q3 of 2022. 71% reported that they beat estimates, which sounds great. But in fact, the average beat over the last 5 years has been 77%. So as I mentioned in the past, when it comes to earnings seasons, companies try to basically put the bar really low so they could beat it. Well, they're not beating it enough. And that's definitely hurt sentiment when it comes to the market, right? After all, earnings is what drives one of the biggest drivers for markets in the long term. Okay, so now let's get to the main event here, which is Fed week. When the Fed presents interest rates and if they're hiking or if they're lowering or if they're doing anything, is the Catalina wine mixer of monetary policy. It's a huge deal. And this one did not disappoint. The central bank decided to hike interest rates 75 basis points, which was expected by the market. But just to give you some context, the Fed has only hiked 75, or I should say, the Fed has only moved interest rates up or down 75 basis points in one shot 5 times. That's 5 out of 69 times. So only 6% of the time have we seen such a drastic hike by the central bank. And the market did not like it. In fact, the market hated it. The bespoke group pointed out an interesting data point. The markets, S&P 500, saw the worst last minute, 90 minutes of a Fed day for the S&P. It was down 3.2%, is the worst we've seen since 1994, which in fact was the first year in which the Fed started to make policy decisions on the day that they met, right? So market did not like it. And if you read between the lines of why, I mean, after all, the market was expecting 75 basis points hike, is that in the commentary, Chairman Powell made the point of saying, look, we are committed to beating inflation. Essentially, like, don't try to call our bluff here. We're going to keep raising interest rates. And in fact, maybe raise them a little bit higher than we originally intended, right? Market hated it. If rates go up, affects the economy in a negative way. It affects valuations for stocks in a negative way. And that's why the market sold off. Now, what else happened this week? Oh, one last thing. This morning, today's Friday, we saw payroll numbers of 261,000 and unemployment rate of 3.7. Just to give you a sense of expectations, prior to that number, the market was expecting 250,000 jobs. So it did better than expected. Unemployment rate at 3.7 was around what the market expected as well. Labor force participation held at 62.2. So overall, the message here is that the job market remains pretty strong. And that's good from an economic standpoint, right? We don't want to see people losing their job. From a market's perspective, this signals that the Federal Reserve has more room to continue to hike interest rates because they haven't seen slack in employment deteriorate. Usually you need slack in employment for wage growth to come down. Wage growth is one of the biggest drivers of inflation, right? So it's one of those, like, it's good news, but the market might read it as bad news type thing. What do we look for next week? 150 companies are reporting earnings, so big earnings week. We also have midterm elections on Tuesday. The House remains a toss-up, and it looks like, the Senate is a toss-up. The House looks so far, probabilities higher than 50% that it will go to Republicans. The markets are going to continue to watch this closely. In the long term, midterm elections, elections in general don't drive markets. In the short term, they can. So we'll watch what comes out of Tuesday. And then we have CPI numbers, inflation numbers later in the week, next Thursday. As I mentioned, if you have one word to remember, what's driving markets is inflation. So obviously we're going to keep a close eye to those numbers. All right, stay tuned for next week.